Nokia OYJ on the New York Stock Exchange under ticker symbol NOKA is currently closed following the last regular trading session. The stock ended the session at exactly $10.21 per share, reflecting a minor bump of 0.89% or up 0.09 points on the day. While the broader retail crowd looks at Nokia stock and sees a slow-moving legacy telecom hardware provider struggling through cyclical carrier spending cuts, the reality playing out under the hood is fundamentally different. Wall Street has priced this equity like an aging cyclical equipment vendor, yet institutional flow and strategic capital positioning are pointing toward a silent structural transition into AI data center switching and private enterprise infrastructure. The expectation is that Nokia stock is trapped in a flat range because telecom operators in North America and India pulled back on 5G radio access network spending. The reality is that the margin profile inside their network infrastructure and optical networking divisions is undergoing a quiet, high-margin re-acceleration that the retail market has completely mispriced. When you look across popular retail platforms like Robinhood stock trading or active accounts on Interactive Brokers trading, Nokia stock often gets lumped into the defensive dividend category or ignored entirely in favor of high-flying semiconductor names. But if you look closer at the institutional footprint across various platforms, including individual brokerage accounts at Fidelity Investments, you notice subtle accumulation occurring ahead of major network refresh cycles. The immediate price action around $10.21 per share comes directly on the heels of major structural realignments within the European and global telecommunications sector. Over recent trading sessions, trading volumes for Nokia stock have experienced sudden spikes above their historical daily averages, signaling that larger market players are shifting capital ahead of upcoming quarterly reports and operational guidance updates. The primary driver behind recent daily swings is the ongoing tension between carrier capital expenditures and enterprise edge buildouts. When major telecom giants announce reductions or delays in their traditional cell site upgrades, retail investors tend to panic and sell down Nokia stock, viewing it purely through the lens of mobile networks. However, institutional algorithms track a very different metric: the steady expansion of high-bandwidth IP routing, optical infrastructure, and private wireless networks deployed directly to industrial clients. This disconnect between headline macro sentiment and underlying segment performance creates localized volatility that sharp traders on platforms like SoFi Invest or through self-investing tools repeatedly exploit. While the broader public reads headlines about stagnant carrier equipment sales, corporate buyers on Interactive Brokers stock trading platforms are positioning around Nokia's growing optical networking market share, where data center interconnect demand is silently accelerating to keep pace with global computing workloads. To understand why Nokia stock is behaving this way today, you have to dissect how expectations were built in the first place. For years, the market narrative surrounding Nokia stock was anchored entirely to the global 5G rollout. Investors assumed that as telecom operators worldwide rushed to upgrade their towers, Nokia would print steady, high-margin revenue for an entire decade. Retail traders flocked to online trading applications, using Robinhood Investments or opening a SoFi active investing account to catch what they thought would be a multi-year linear growth trend. But reality hit hard when telecom providers finished their initial coverage phases and abruptly dialed back capital expenditures to conserve cash amid elevated global interest rates. The market responded by pounding Nokia stock down, treating it as a commoditized hardware business with zero pricing power. This is where the gap between expectation and reality offers a compelling setup. The market expects Nokia to remain a hostage to telecom spending cycles forever. The reality, however, is that Nokia has spent the last few years aggressively diversifying away from pure carrier mobility. They have re-engineered their business model to target web-scale tech giants, cloud providers, and industrial enterprises that require specialized fiber optic backbones, advanced IP routing, and low-latency private networks. Comment below how many shares of Nokia stock you currently hold in your portfolio and whether you are holding for the dividend yield or waiting for an enterprise growth turnaround. To truly grasp the foundational assets supporting Nokia stock today, it helps to review what the company actually does beneath its massive global umbrella. Founded back in 1865 in Finland as a simple paper mill, Nokia evolved over more than 150 years into a global industrial giant, famously dominating the mobile phone industry throughout the late 1990s and early 2000s. After selling off its consumer mobile phone division to Microsoft over a decade ago, Nokia fundamentally transformed itself into a pure-play B2B communications technology powerhouse. Today, the business operates across 4 core segments: network infrastructure, mobile networks, cloud and network services, and Nokia Technologies. The network infrastructure division focuses on fixed networks like optical fiber, IP routing, and submarine cables. Mobile Networks supplies global operators with radio access network equipment, microcells, and 5G base stations. Cloud and Network Services delivers automated software platforms and core network architectures. Finally, Nokia Technologies handles one of the world's most valuable intellectual property portfolios, generating billions in pure, high-margin cash flow through patent licensing agreements with smartphone makers, automotive brands, and consumer electronics giants. Past financial performance shows that while top-line revenue growth can appear sluggish due to legacy contract roll-offs, the underlying gross margins have actually expanded as intellectual property licensing and high-end enterprise software become a larger share of the total revenue mix. Looking ahead at the future outlook for Nokia stock, the main story revolves around 3 critical catalysts: enterprise private 5G networks, AI-driven data center optical connectivity, and structural cost reduction initiatives. The market currently prices Nokia stock as if its growth ceiling is permanently capped by traditional telecom budgets, but as massive artificial intelligence clusters demand unprecedented bandwidth between server racks and data facilities, the need for high-speed optical routing and data center interconnect technology is soaring. Nokia is positioning its custom silicon and switching hardware directly into this hyperscaler market, competing for high-margin deals that carry far better profitability than traditional mobile base station rollouts. Furthermore, their ongoing operational efficiency programs are cutting fixed structural overhead, meaning that even a modest stabilization in global network spending will translate directly into expanding operating margins and accelerated earnings per share growth. The downside risks, of course, remain tied to geopolitical tensions, potential delays in enterprise tech spending, and fierce competition from global rivals in the networking hardware space. Yet when evaluated through the lens of expectations versus reality, the current market valuation on platforms like Fidelity Brokerage or Schwab Intelligent Portfolios reflects a stagnant legacy hardware firm, while the underlying operational reality shows an enterprise-focused, cash-generative technology network company preparing for its next structural operational phase. In summary, Nokia stock sitting at $10.21 represents a classic market mispricing driven by outdated narratives. The crowd continues to expect a tired, cyclical telecom vendor bound entirely to carrier spending swings, but the actual reality on the balance sheet shows steady margin expansion, high-margin patent income, and a strategic entry into AI-driven optical data center routing. As institutional capital continues to evaluate these shifting fundamentals, the tension between what the public expects and what the business actually delivers will remain the single most critical factor determining where Nokia stock trades over the long term. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Don't forget to like, comment, and share this video to support the channel.